as the government bonds are set to be included in the JP Morgan Government Bond Index, the emerging market index, from tomorrow, that's June the 28th. Now, the inclusion will occur over a period of 10 months starting Friday and go up until March 31st, 2025. India will at the start have a 1% weight in the JP Morgan EM Bond Index, and this will gradually rise to 10% over a 10-month period. That's the highest that can possibly go. The inclusion is estimated to bring upwards of $20 billion of inflows into India's bond market. Since September last year, we've already seen inflows of about $10 billion come in, and these inflows are expected to help manage debt and can help India move towards its 5 trillion economy target by 2030. I'm joined by Ajay Manglunia, Managing Director and Head of Investment Grade Group at JM Financial, to share his views and his expectations from the index inclusion. Mr. Manglunia, thank you so much for taking time out.
Yeah, hi Pallavi, thank you. It's my pleasure to be here.
So, yeah, it's it's quite a watershed moment in the debt market, one that we've been waiting on for a while now. In the near term, like for the longer and for the medium term, while we do have expectations of inflows ranging upwards of at least about $20 billion, I do want to understand what is it looking like in terms of expectations for the near term.
So we can expect a gradual flowing into the market, and basically, as you have rightly mentioned, that it's 1% weightage right from beginning of June and till 31st March. So 1% weightage each month will kind of ensure that there is a steady flow coming into the market. With the expectation of this JP Morgan indices inclusion, I think a couple of foreign investors, especially who are opportunists and don't follow market index, in the expectation I might have started pouring in money. So if we see that about $8 to $10 billion since last 7-8 months since the announcement in September has already flowed in, and those guys with the expectation of this weight is likely to be there, and India being after the China is the largest allocation, and JP Morgan is just the beginning, but there are other index followers who will also looking at the macro numbers and the comfortable situation in India are likely to start including Indian bonds in the global indices. So as of now, to begin with, 28 securities which are part of the FAR investment grade, wherein it's automatic investment approvals, and they are likely to see the flows, and we can expect that this will not only get the inflows in India, which is very much needed and helpful, but at the same time, this will kind of ease the pressure on the yields, and looking at the stability in the currency, looking at the stability in the flows, looking at the macro numbers, and all of those things will make people more comfortable. Stability in the currency is basically a reason why most of the global investors are likely to be comfortable with a better carry on the bonds.
Okay, all right. Mr. Manglunia, any expectations in terms of whether we can expect a spike in terms of inflows in the next couple of days or so? Or do you think, like you've mentioned, it is largely expected to be more gradual over the next few months?
So it's all investors to investors expectations. As we see, the rate cut environment is still to begin. And Pallavi, if we see today, Bank of England has already started the rate cutting, but people are waiting for Fed to start the rate cut. The macro numbers with the inflation forecast and with the employment data and all of those suggest that there has to be some rate cut in this calendar year. Now, the point is to be seen is whether Fed takes a first step and RBI takes a first step is what we need to see. But overall, the consensus in the market is that in this calendar year, there will be at least one rate cut. The rate cut beginning will happen, and predominantly that will probably put a trigger for the investors. And investors obviously would like to get into the market before the rate cut scenario starts. with the flows coming in, expectation of the rates easing will obviously a reason why investors would be in a hurry to pour in the money. But is the people who follow the index will have to come in based on the weight assigned to the index. So $2 to $2.5 billion per month is what we can expect. Not a very large flows. And at the same time, as we see that central bank is very, very visible and has been kind of ensuring no volatility in the market, let it be fixed income, let it be bond yields, let it be the currency market and all of that. They've been kind of very prompt and they've been kind of ensuring that market works in a seamless manner. So I don't see a huge volatility because of these flows, and the flows are measured in a gradual manner.
Okay, so flows likely to come in a gradual manner, according to you, Mr. Manglunia, and say we're looking at figures of about $2 billion over the next 1 month, and that's likely to be the trend going forward as well. Is that the right summary?
Yeah, absolutely. And this is basically about 10-12% of the auctions we see from the central bank in the market for these government securities. So that's a new demand coming into the market, and that will probably ease up the yields pressure. And it's not only on the government securities, but then as we have been expecting that gradually government securities yield is the best, and that's basically the reason why all other instruments are priced on the base effect of government securities yield. So I expect that a large number of PSUs have been borrowing the corporate bond issuances, a large number of NBFCs in the market, corporates who have been borrowing from the market will also have an advantage of this environment. In the last 2-3 years, we have been seeing a desertation in the market, in the sense like there's not been absolutely any flows from the foreign investors besides some of the distressed special situations. But getting flows into the market in the performing and the high grade quality of the debt instruments is something India was long waiting for. And that will have its positive impacts. I don't see any negativity around it.
Sure. Okay, Mr. Manglunia, any estimates you have in terms of the bond yield movement in the short term?
So we expect that with these flows and the kind of demand we have for the issuances, the yields will definitely ease up by at least 25 basis points, if not more. So 675, 680 types is a number which everybody on the street might be expecting. There's absolutely no unreasonability. If we look at it, the real interest rates compared to the inflation, 1.5-2% is what the real interest rates we can expect. And today the inflation is well below 5%, and the GSEC yields, if we look at it, 675 is a consensus, and we should be there very soon. And any other inclusion, any more flows, and any easing on the rates by central banks and all of that is icing on the cake.